It's very hard to know whether the bottom is actually in or not, and it does feel good that the market has stabilized a bit here, but I would caution investors to automatically assume that the worst is over. I mean, if you go back to 2008, just as an example, but you can use other bear markets as an example as well, but in '08, from September to December, you had the market rally 6 times between 9 and 19%. So what is going on right now is not unusual within the context of a bear market. I mean, frankly, what would make me start to feel a little bit better is multiple days in a row where the market's only moving 1 or 2%, either to the positive or to the negative. These wild swings back in one direction or another, what it tells me is that investors are still having a hard time finding the price that they believe is accurate for the most probable future outcome. There's just so much uncertainty. We don't know how long the economy is going to be shut down. The blind spot as it relates to GDP contraction, earnings, it's still so big that I think to assume the worst is over is probably a little bit premature at this point.
All right, there are a number of Wall Street strategist types out there who think that the volatility downside could continue. What exactly then would be the driver of that? There are those who argue that much of the bad news has already been priced in, given the precipitous drops we've seen. What could get worse about the coronavirus that would then send markets into another hypothetical leg lower?
Look, to me, it feels like we're kind of in the eye of the storm a little bit, where investors have gotten comfortable with the idea that the economy is going to slow. They've gotten comfortable with the idea that there's going to be some impact on earnings. But just as the initial unemployment claims came in last week, really at an unprecedented level, I think as we start to actually see those data points come in, it is going to have an impact on the market. I think as we start to hear a little bit more from companies and understand what the impact is going to be on earnings, I do think that that's going to have some sort of negative downside effect. So although the slowing economy is a known, I think the magnitude is perhaps still unknown. And as we actually start to see those data prints come across the screen, I think that in and of itself could be enough of a catalyst to at least prevent the market from moving steadily higher from here.
All right. We've talked at length in months and years past about the fact that corporate earnings are one of the primary drivers of stock prices. We know corporate earnings are going to be bad this year. How bad could they get?
Well, that is very hard to know because we don't have visibility as it relates to the economic shutdown. But what I will say is they haven't come down in terms of expectations as much as they're going to need to. As an example, at the beginning of the year, I think Wall Street estimates were somewhere around 170, 175. I think expectations have come down to 165. If you just look at your typical recessionary year, that would put us in the neighborhood of about $118 a share for earnings. So if that gives everyone a little bit of an idea about what they can expect through the end of the year. I think the good news is once we move into, say, the third and fourth quarter and investors start setting their sights on 2021, then I think the market can actually start to move ahead a little bit. I mean, if you assume things do snap back to a reasonable degree, and we have $170 a share for earnings in 2021, then I think you start to put a reasonable multiple on that and the market can move higher from here.